$1.8 million. That is the approximate gap between what the market returns over a 30-year career and what the average investor actually earns. Same market, same decades, same funds. The market hands out roughly 10% a year. The average investor walks away with about a third of that. The other 2/3 are not stolen. They are not lost to fees, not lost to bad luck, and not lost to the wrong stock. They are lost to behavior. 3 behaviors, to be exact. The patient 1% practice them. The reactive 99% skip them. Which one are you? There is a research firm called Dalbar that has been running one specific study every year since the early 1990s. They call it the quantitative analysis of investor behavior. Vanguard, Morningstar, and a handful of academics have built their own versions of it. The headline finding has barely changed in 3 decades. The market, measured by the S&P 500, returns roughly 10% a year over long horizons. The average investor in that same market earns roughly 3.5%. Same fund, same years, different outcome. The gap is about 6.5 percentage points. Compounded over a 30-year career on a typical retirement balance, that gap is roughly $1.8 million in real money left on the table. Quick note before we keep going. This is education, not advice. There are no specific tickers and no recommendations in this video. Just the math and the names that produced it. So why does the gap exist? Not because the 99% are lazy. Not because they are stupid. Because they are human. The math just punishes humanity. The market is a machine designed to test patience, and the average nervous system was not built for 30 years of doing nothing. Quick question before we go further. In 2020, when the market dropped a third in 33 days, did you sell anything? Anything at all? Yes or no? Drop it in the comments. No judgment. Just curious how many of us are honest with ourselves. Now back to the data. Habit number 1. Stay invested through the drawdowns. 2008. The S&P 500 fell about 37%. 2020. The S&P fell roughly 34% in 33 days. The fastest crash in modern market history. The 99% did the obvious thing. They watched the account balance shrink, listened to the news, felt the panic rise into their chest, and they sold. Most of them sold near the bottom, locked the loss in, and then stayed in cash through the recovery. The patient 1% did something almost insulting in its simplicity. They did nothing. They did not check the account every hour. They did not move money. They sat. Here is the cruel arithmetic of why that matters. Over the last 20 years, if you had stayed invested in the S&P 500 the whole time, you earned roughly 10% a year. Miss just the 10 best trading days, and your return drops to roughly 5.5%. Miss the 30 best days and you are basically at zero. And here is the kicker. Those 10 best days almost always cluster inside the worst weeks. The rebound is buried inside the panic. The only way to catch it is to never have left. The behavioral name for the trap is loss aversion. Humans feel the pain of a $10,000 loss roughly twice as hard as the joy of a $10,000 gain. That asymmetry is the lever the market uses to pry weak hands off the elevator. Doing nothing during a crash is one of the hardest things in finance. It looks lazy. It is actually disciplined. Pause for a second. If you're still watching, here's the uncomfortable truth. Most people who clicked on this video have already done at least one thing the 99% does. That's not a flaw. That's gravity. The market is engineered to pull you off course. The only way to stay on it is to know exactly which 3 habits the 1% use to resist. Those 3 habits are the rest of this video. Subscribe so the algorithm sends you the next framework, and so when the next correction hits, you've already got the script. It costs you nothing. Back to the math. Habit number 2. Stop trying to time the market or pick the next winner. Every year, a research project called SPIVA compares active mutual funds to their benchmark index. The finding does not really change. Over 15 to 20 years, roughly 92% of active U.S. equity funds underperform the simple index they are supposed to beat. 9 in 10. That alone should end most stock-picking conversations. But the deeper finding is the one almost nobody talks about. Even when an active fund does outperform, the average investor in that fund still tends to lose. Morningstar runs an annual report called Mind the Gap that measures it. Vanguard runs its own version. The pattern is the same. Investors pour money in after a hot streak. They pull money out after a cold one. They buy high, sell low, and then call it bad luck. Vanguard estimates this return gap, the difference between what the fund earned and what the investor in the fund earned, costs roughly 1.5% to 2% per year. Invisible, untaxed, entirely self-inflicted. Now run the math. 2% a year, compounded over 30 years on a 10% market, is roughly half the final balance. Half. That is the cost of being clever. John Bogle, the founder of Vanguard, said it as plainly as anyone has ever said it. Do not look for the needle. Buy the haystack. Owning the market does not require a forecast. It does not invite the buying and selling that destroys returns in the first place. The patient 1% stop trying. The reactive 99% never do. The behavioral names for the trap are overconfidence and recency bias. Overconfidence says you can pick. Recency bias says whatever just went up will keep going up. Together, they manufacture the gap. Habit number 3. Hold past year 10. Compounding does not work the way charts on the internet suggest. It is not a smooth diagonal line. It is a curve that looks almost flat for a decade and then bends sharply upward. Picture this. $10,000 placed into a broad U.S. equity index in 1990. Untouched. Dividends reinvested. By the end of 2024, that $10,000 is worth roughly $340,000. 34 times the original deposit. But to get there, you had to sit through 3 crashes: 2000, 2008, 2020. And you had to sit through 1 full decade, the 2000s, where the market essentially went nowhere. 10 years of investing. Effectively zero return. The reactive 99% quit somewhere between year 4 and year 9. Right at the bottom of the curve. Right before it bends. They look at the flat line and they say, "This is not working." Then they walk away. The patient 1% sit through the boring middle. They do not interrupt the experiment. Charlie Munger, Warren Buffett's partner of more than 50 years, said it best. The big money is not in the buying or the selling. It is in the waiting. John Bogle said the same thing in different words. Time in the market beats timing the market. Here is the kicker that makes the case impossible to argue with. Warren Buffett earned roughly 99% of his net worth after the age of 50, not because he got better at picking, because he had time on the curve. Compounding does not happen despite the boring decade. It happens because nobody interrupted it. Patience is not a virtue here. It is the mechanism. 3 habits, 1 discipline. The patient 1% close the gap not by doing more, but by doing less, on purpose, for 30 years. Here is the full framework. We will call it the 1% discipline. 3 verbs: stay, stop, hold, stay. Stay invested through the drawdowns. The crashes are not your enemy. The buttons you press during the crashes are: loss aversion is the trap. Sitting still is the answer. Stop. Stop trying to time the market and stop trying to pick the next winner. Roughly 92% of professionals fail at this over 15 years. The amateur with the same goal and a phone in hand has roughly the same odds. Owning the market removes the temptation. Overconfidence and recency bias are the traps. Buying the haystack is the answer. Hold. Hold past year 10. Compounding spends most of its time looking like nothing is happening. The reward arrives only for the people who do not quit before the curve bends. Impatience is the trap. Time on the curve is the answer. 3 verbs, 3 habits. 0 stock picks. The entire $1.8 million gap closes here. Not in the buying, not in the selling. In the not selling, the not switching, and the not quitting. Here is the line worth carrying past this video. The 1% are not richer than the 99% because they are smarter. They are richer because they are calmer. The market does not pay you for being right. It pays you for staying, for not switching, for not quitting. Stay, stop, hold. 3 habits, 1 discipline. The patient 1% closed a $1.8 million gap, not by doing more, but by doing less on purpose for 30 years. The discipline is the inheritance, and it is one of the only inheritances you can hand yourself. Here is what to do this week. Open one statement, any account. 401k, IRA, brokerage. Run the 3 checks. Question 1. Did you sell anything during the last drawdown? Question 2. Are you trying to pick winners, or do you own the market? Question 3. Have you held your core position for 10 years? 3 yeses. You are in the 1%. 1 no. You have found your gap. The fix is not a stock pick. It is a habit. The next narrative drops in 2 weeks. Another framework. More evidence. Subscribe and turn on notifications so the algorithm hands it to you the day it is live. Build wealth with patience, not panic. Calm investors.